It's time for a little myth busting. This is my favorite part. An active manager is a better manager. How many times have you heard that? How many active managers have we had on saying that? But wait a minute, not so fast. The reality is active managers continue to underperform their benchmark. The S&P Dow Jones Indices published its annual SPIVA report last week. Again, showed that even with heightened market volatility last year, active managers struggle to outperform. Over the long-term horizon, such as 10 or 15 years, look at these numbers here. The performance is even worse. 85% of large-cap managers underperformed after 10 years, and almost 92% underperformed after 15 years. That's terrible. And in this case, size doesn't matter. The same dismal numbers apply to small and mid-cap fund managers. It doesn't matter what you look at. More than 85% of those guys also underperform. Look at these numbers. Todd, S&P has been doing this for 16. This didn't just happen. They've been doing this for 16 years. The results are consistent. What does this tell us about the inability of the active managers to outperform? What is it? What's the conclusion?
So for most of the funds that underperform, the reason is because of the fee. So you now have, as we talked about, 3 basis point exposure to get to the S&P 500. The average actively managed fund charges 100 basis points or more. In the small cap space, which is supposedly where you find hidden gems, the numbers you highlighted earlier are stark examples. Yeah. You can find good active managers. Yeah. It's just hard to consistently do that.
And Tom, this was Jack Bogle's central insight more than 30 years ago, that even when you get good active managers, and Vanguard had excellent and still does have excellent active managers, he was not opposed to active managers, but even when you get them, the fee they charge destroy any alpha that they actually have.
Right. And your point, 92% underperform over the last 15 years. I think active management is going the way of cigarettes. Back in the 70s and 80s, mutual funds were hot. They were rock stars. It was really, really cool. But over time, fast forward to today, active management is not healthy for your financial health. It's not as cool, and it's expensive. To Todd's point,
Will,
it's really expensive.
You run an ETF, but where do you stand on the active management debate? Do you think it's still possible for people, even in the commodity space, to pick a basket that would outperform?
Active management is like singing. It's a talent. Some people have it, but the vast majority of us don't have it and will never have it. I think that when it comes to this point about longer term, fees, taxes are really important. But for me, it's also the information age as being the biggest game changer. The DIY investor has never been more empowered and has never had more access to data than they do just now. And that is something that just 10 years ago, 15 years ago, didn't happen. And so that information advantage, if you will, has gone away. And I think that's really tough for the active investor.
And what you have also is you have these low-cost products that are tied to the S&P indices that are in here, offered from iShares, from State Street, from Vanguard. But if you did want something that was a little bit active, you could have the smart beta products Tom touched on earlier. You could have a value slice of it. You could have a more low volatility part of that portfolio for 15 basis points or less. And so that bar is not much higher for the smart beta, the quote-unquote active or quasi-active approaches as you'd have for traditional index-oriented products.
Once again, I go back to my mentor, Jack Bogle, who said if it's the fee that matters, if you're going to pick active management, pick the lowest cost that's at the best performer, and that's the real key to the game. Again, Jack was never opposed to active management. They have terrific people. I want to note that this report specifically deals with survivorship bias, because there's these problems with these reports. 50% of the funds close after 10 years because the performance is so bad. So they get excluded from the studies that make everybody who's surviving look even better. And the study corrects for that particular bias. It's a very important methodological aspect of this.
Right. The number of funds that survive within 15 years is a very small number. So the universe...
50% die after 10 years.
Shrinks considerably. So one, you may find someone that outperforms for a year or two, but they're not likely to continue, and they may not be around anymore, whereas obviously the ETF is going to go on in much longer period of time.
Is it any wonder why we talk about ETFs, low cost? People look at me, oh, it's going to blow up someday. Too many people.
And why there's still trillions in actively managed mutual funds, kind of like cigarettes, again. They know it's unhealthy for you, but it's really tough to quit, right?
That's another subject. How sticky that money is over there. That's a subject for another day. We're going to have to leave it, though. We'll bring you guys back to talk about this. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Tom Lydon, Todd Rosenbluth, and Will Ryan for joining us today. Thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday. Same time, same place. Have a good week.